Welcome everyone to another episode of Navigating Abundant Retirement. I'm Carol Dewey, and today's session may be one of the most valuable you'll ever attend as a business owner or high net worth professional. You've worked hard, you've sacrificed weekends, invested every ounce of your energy, and poured years into building your business. Now you're finally considering an exit. Maybe retiring is on the horizon, maybe you want to free up time for family, or maybe you simply are ready for the next chapter. But here's the question that keeps too many owners awake at night. What happens when I sell? The sobering reality is that when business owners go to market without a proactive strategy, they often lose 30 to 40% of their proceeds to taxes. That's not just numbers on a page. That could be the dream vacation home, your grandchildren's college fund, or the security of knowing you'll never outlive your retirement income. The good news is it doesn't have to be that way. Today we're going to talk about how you can exit without regret. We'll walk through proven strategies for mitigating capital gains, deferring taxes, and even turning tax traps into opportunities. Along the way, I'll share stories of real owners who kept millions in their pocket by planning ahead. So let's get started. First, let's be honest about what's at stake. When you sell your business, the IRS and state governments line up to take their share. You may face capital gains tax on the appreciation of your company, depreciation recapture if you've written off assets, state taxes depending on where you operate or reside, and net investment income tax if your adjusted gross income crosses certain thresholds. When you add it all up, it's not unusual for a business owner to lose up to 40% of the sale proceeds to taxes. So here's a case study. A dentist in the Midwest sold her practice for $5 million. Without tax planning, she owed $1.7 million in taxes, money that could have provided lifetime income for her and her spouse. Fortunately, with a team approach, she was able to use deferral strategies to cut her tax bill nearly in half. The key lesson? Once the ink is dry on the sales contract, your options narrow. The time to plan is before you sell. So how do you keep more of what you've built? The first step is understanding capital gains. This is the tax you pay on the profit from selling your business. The rate can range from 15% to 23.8% federally plus state taxes. But here's the good news. With intentional planning, you can mitigate or even eliminate a significant portion. Some of the strategies include installment sales. That's spreading payments over time, allows you to spread out tax liability and potentially stay in a lower bracket. Charitable remainder trusts. By placing part of your business in a CRT before the sale, you can defer capital gains, take a tax deduction, and still receive income for life. And opportunity zone funds. Rolling part of your gain into designated zones can defer and potentially reduce taxes. Here's another case study with a Kentucky manufacturer. A Kentucky business owner sold his family manufacturing business for $12 million. His accountant had him set up for a straight sale, which would have triggered nearly $5 million in taxes. After a consultation, he chose a combination of an installment sale and a charitable remainder trust. His upfront tax bill dropped to under $2 million, freeing an additional $3 million for reinvestment and income planning. Now that's the power of planning. Not every business owner wants to give up control of their money, and that's where deferral strategies can come in. Some examples might be structured sales. Think of this as a prearranged installment sale with an insurance company. You can customize income streams while spreading taxes over years. Deferred sales trusts. These allow you to sell your business, transfer proceeds to a trust, and defer taxes while reinvesting in other assets. And of course, 1031 exchanges for real estate heavy businesses. You can roll gains into new property investments and defer taxes indefinitely. Deferral is powerful because it gives you time, and time gives you options, whether it's reinvesting, smoothing out income for Medicare thresholds, or creating generational wealth. One of the most overlooked tools in advanced planning is the Wealth Replacement Trust. Now here's how it works. Let's say you choose a charitable trust to defer taxes. That means part of your estate eventually goes to charity. But what about your heirs? A wealth replacement trust funded with life insurance ensures your children or grandchildren replace that wealth tax-free. I've got another case study to share here, the franchisee. A couple who owns several franchise restaurants decided to exit. They set up a charitable remainder trust which gave them lifetime income and deferred their capital gains. To ensure their heirs didn't feel left out, they used a wealth replacement trust to leave a tax-free $5 million legacy to their children. The result? They lived generously, reduced taxes, supported a charity they cared about, and still passed wealth to their family. That's a win on every front. Now let's pause here and speak directly to you, my ideal client. You're not just trying to sell a business. You're trying to protect a legacy. You spent decades building something valuable, and now you want to make sure the rewards serve your family, your retirement, and your greater purpose. But your pain points are clear. You don't want to lose control of your exit to taxes. You're unsure if your CPA is equipped for advanced strategy. You're worried about timing, sell too soon or too late, and you could leave millions on the table. And your aspirations are equally clear. You want to keep more of what you've earned. You want to ensure your family and causes you care about benefit, not just the IRS. You want to exit with peace of mind, without regret. This is where a coordinated team, financial planner, tax strategist, and estate attorney comes into play. And this is exactly the role we play at Claris Advisory Partners and Perpetual Wealth Financial. So what's next? If you're within 5 years of a potential exit, the time to plan is now. Here are 3 action steps. First, get a business valuation. Know your baseline. You can't plan effectively without knowing what your company is worth today. Second, assess your tax exposure. Work with a strategist who can model your potential tax bill under different scenarios. And third, design a custom exit plan. Don't settle for cookie-cutter solutions. Your plan should fit your goals for income, legacy, and lifestyle. Selling your business is one of the most important financial events of your life. Done right, it can fuel your retirement, empower your family, and build a lasting legacy. Done wrong, it can leave you with regret and the IRS with a windfall. The choice is yours. Plan early and you can exit without regret. Thank you for being here today. We've covered strategies that can literally mean the difference between giving up 40% of your hard-earned business value or keeping it to fund your retirement, protect your family, and shape your legacy. The key is planning before the sale happens. Once the deal closes, your options shrink dramatically. That's why I invite you to take the next step. Schedule your complimentary lifestyle and legacy assessment. We'll review your current exit plan, uncover risks, and explore tax-smart strategies that fit your unique situation. I'm Carol Dewey with Perpetual Wealth Financial and Claris Advisory Partners. We help you exit without regret. Thank you. I look forward to guiding you on your next steps, and I will see you again next week.